All right, guys, let's go through 215B here. So this one, we're going to kind of do a little bit of everything: supplies, unearned revenue, financial statements model, just a bit of everything. What they're going to give us here is kind of that initial setup here, our first transaction. So our first transaction tells us that they purchased office supplies on account. That's an easy one for us, right? We can see here that we've got supplies increased by $1,500, accounts payable increased by $1,500. Our accounting equation still balances. It's an increase on an asset and an increase to a liability for the same amount, so we are still good. They also give us a little bit of a check figure down here. We've got that 7650 or 75,650. That's going to be a bit of a check figure for us. We know that our retained earnings has to total up to that. If it doesn't, we've got something off somewhere up above. So let's go ahead and take a look at transaction number 2 here. Transaction number 2 tells us that we accepted $36,000 on February 1st, year 1, as a retainer for services to be performed evenly over the next 12 months. This is interesting because what it's telling us is that we haven't earned any of this yet. It's simply a retainer, so we don't get to count it as revenue, but we're going to earn that revenue evenly over each month of each of the next 12 months, regardless of how much work we do. So if at the end of month 1 we've not done anything for the client, we're still going to earn X amount of revenue. The way we find that is we're going to take 36,000, right? Multiply it times 1 over 12. So that just turns into 36,000 divided by 12, which equals $3,000 per month, right? That we are going to recognize as revenue. What that'll end up doing for us, right, is we will have our unearned revenue account. Have our unearned revenue account. Right, it's a liability, so it's over here. It's going to start at $36,000. Okay, and we'll have a revenue account. And each month, okay, we're going to take away from this one by $3,000. We're going to add to this one by $3,000. This is the recognition that we have earned that amount of revenue. Okay, so hopefully that makes sense to you. We'll go ahead and keep moving here. So number 2, well, we had $36,000 in cash. That's what they gave us. Okay. No supplies, that's not impacted. Accounts payable, not impacted either. But we did impact that unearned revenue account by $36,000, an increase by $36,000. And retained earnings was not impacted. Remember, we do not have any revenue yet. We do not have any expense yet, so there is no impact on retained earnings. Here we'll again see there is no revenue, there is no expense, so there is no net income impact. And this was simply a $36,000 inflow in operating activities. All right, transaction number 3. It tells us that we performed legal services for cash of $84,000. So automatically we know we got an increase in cash of $84,000. There was no impact to supply here. There is no impact to account payable here. There is no impact to unearned revenue, but there is an impact to retained earnings in the amount of $84,000. Why is that? Because since this was cash and we performed the service, we're going to call that a revenue. There is no impact on expenses, and so your total net income for that transaction is going to be $84,000. Now, this was an increase or an inflow of cash in the amount of $84,000 as an operating activity. Hopefully that one makes sense. These cash type transactions are usually the easiest ones. So for number 4, it's going to tell us that we paid cash for operating expenses in the amount of $32,000. This one's easy. We can already figure out our cash flow there, right? So negative $32,000 is our cash. No impact to supplies, right? No impact to accounts payable. No impact to unearned revenue. but it will have a negative $32,000 impact to your retained earnings because an increase in an expense is a decrease in retained earnings. Was there an impact in revenue? No, no impact to revenue. Is there an impact to expenses? Yes, there's an increase in $32,000 to the expense, right? Which means we have a negative $32,000 net income or a net loss there. What was our cash flow? Well, it was a $32,000 outflow of cash as an operating activity. So this is just the way we're going to analyze these transactions each time. Number 5 is going to give us information. So we paid a cash dividend to stockholders of $8,000. So again, it's going to be a decrease of $8,000 in cash. No impact to supplies, nowhere to be found. No impact to accounts payable. No impact to unearned revenue. But there is an impact to equity. It is going to be a negative $8,000 decrease to equity. No impact to revenues. No impact to expenses, right? And so there is no impact to net income. The reason is dividends are not a component of the net income calculation. They're a component of the retained earnings calculation. So we keep it separate from that revenue and expense function. A dividend is just a dividend. That's it. Dividends are dividends, nothing more. Okay. So this is, again, a negative $8,000 outflow of cash, but as a financing activity. Okay. We are, since dividends aren't an expense, we don't consider it to be an operating activity. It's more like meeting an obligation or satisfying a debt in reality. So that's why we classify it as financing. Number 6 tells us we paid $1,200 of the amount due on accounts payable. So interesting here. Paid to me means cash. Didn't tell us we did anything other than pay cash. Again, no impact on supplies. However, now we have reduced our accounts payable by $1,200, right? We owe $1,200 less than we did. No impact on unearned revenue. No impact on retained earnings because there is not an expense component here, which means no impact on net income. However, we do have a $1,200 outflow of operating activity cash. Okay. These are operating activities. We're paying on an accounts payable. We took out that accounts payable to help us perform our operations, so the associated reduction is going to be an outflow of cash for operations, for operating activities. Number 7 tells us that we have determined that at the end of the accounting period, $150 of office supplies remained on hand. So again, let's just figure that out. How do we figure that out? Well, we're going to start with our supplies account, right? It's an asset. We started with $1,500. We end with $150, so we have X. So 1,500 minus X equals 150. So you're simply going to take that 1,500 minus 150 is 1,350. So negative $1,350. This is your supplies expense, which is your adjustment. Okay, we'll learn about that in another way too. So we've got no cash impact there, right? Because we've already done the cash up above. However, our supplies has reduced by $1,350. No accounts payable impact. No unearned revenue impact. However, there is a retained earnings impact. Our retained earnings is going to reduce by $1,350 because there is that expense component. That adjustment to the supplies account is supplies expense. Remember, we recognize expenses when we use resources. Okay? So we used those supplies. We used $1,350 worth of supplies. That becomes an increase of $1,350 to an expense, which gives us a net loss in that transaction of negative $1,350. Is there a cash outflow here? No, absolutely not. No cash outflow. Cash outflow happened previously in transaction in one of the other transactions. So number 8, it happened in, sorry, I want to be clear, it happened, I believe, in transaction 6 when we paid $1,200 on that account payable. Sorry, should have been more clear about that. So transaction 8 tells us that on December 31st of year 1, recognize the revenue that had been earned for services performed in accordance with transaction 2. Okay. So what do we need to do here? Well, we've got to figure out some allocation. Okay. So here we got to figure out some allocation really quickly. How much did we charge for that retainer? Well, it was $36,000. Right? How long have we had that retainer out? How much of that retainer have we been able to recognize? Well, we got it February 1st, so we've had it for 11 months. So 11 out of 12 months. So this turns into 36,000 times 11 over 12. Okay, which gives us $33,000. This is how much of the revenue we're going to record. Okay, we're going to recognize $33,000 of revenue. This leaves $3,000 of unearned revenue left to recognize next January, but for right now, between February 1st and December 31st of year 1, we have earned 11 months worth of that revenue. So we are going to claim it now. So there is no cash. The cash already happened, right? Cash happened in transaction 2. There is no impact on supplies. We've already dealt with supplies. There is no impact on accounts payable, right? There is an impact on unearned revenue, though. We have to reduce that unearned revenue by $33,000 because now that $33,000 has become earned revenue, right? Well, what is our impact on retained earnings? Well, let's look. Well, we earned $33,000 of revenue. There wasn't an expense associated with that. So we have a net impact on net income of $33,000 increase, which means we're going to increase our retained earnings by $33,000 as well. Okay. Statement of cash flows. Was there any cash involved? No, no cash there. We already got the cash up front when we claim this as a $36,000 inflow of operating activity cash. Okay. So again, we're just going to go through, we're going to total all these up, 70,800. Okay. 150 is what we got left there. So our total assets are 78,950. Okay. Accounts payable totaled $3,000 at the end of the month, or at the end of the year, whatever it is. And excuse me, it was 300. Jeez. And then we had $3,000 worth of unearned revenue left to collect. If we add all this together, 75,650 plus 3,000 plus 300, you will see that 78,950 equals 78,950. We are in balance. This is a good thing. Okay, so we had a total of $117,000 in revenue transactions and a total of $33,350 in expense transactions. This left us with a net income of $83,650, and our total net change in cash was $78,800. Imagine that it matches our ending balance in cash right here on our balance sheet. Your net change should equal your ending balance. That's all there is to that. So again, if you have questions about this particular exercise, please contact me. These are some of the more difficult transactions we've worked through, but hopefully by now you're starting to see how all of this really fits together.